Gold has broken out to new highs, cleanly and decisively, only 4 times in the last 100 years. Every one of those breakouts is now a completed chapter of macro history, except arguably the 4th one, which is still being written: 1933, 1971, 2001, and the breakout that began around 2019. 4 episodes, 4 different macro backdrops, 4 very different shapes on the chart, but one backdrop feature in common. This is not a forecast about gold, this is a catalogue of what the archive actually shows. What the pattern means for you is a question for you and an authorized advisor, not for this channel. Before we get to the cases, we need a short primer on what a gold breakout actually is, because the phrase gets used loosely. Then we move case by case. Chapter 1. A short primer. Gold for most of modern history has traded in ranges, long quiet periods where the price barely moves, interrupted by short explosive moves upward. Those explosive moves are what the archive means by a breakout. A breakout, in this sense, is not a small 20 or 30% rally. It is a sustained multi-year move to new all-time highs, and, crucially, a move that does not get given back within a couple of years. It changes the long-term chart permanently. By that definition, there have been 4 breakouts in 100 years. Each one was visible only after the fact. During the breakout, plenty of people said it was ending. It almost never was. Why does gold behave this way at all? Because gold, unlike almost anything else in a portfolio, is priced against trust. Trust in currencies, trust in central banks, trust in political institutions. When that trust weakens enough, the repricing of an insurance asset is what a breakout looks like. Chapter 2. 1933. The first entry in the archive is unusual. It wasn't driven by the market, it was decreed. In April 1933, private gold ownership in the United States was effectively outlawed. By January 1934, the official price was revalued from $20.67 per ounce to $35 overnight. 69% in a single decree, not a market breakout in the traditional sense, a government revaluation during the depths of the Great Depression. The context mattered. The banking system was collapsing. Deflation was accelerating. The Roosevelt administration was trying to break out of the deflationary spiral by weakening the dollar against gold. The revaluation was the mechanism. What followed was a long period of price stability at $35 for 37 years. Gold was, in effect, frozen. Until it wasn't. Chapter 3, 1971. The frozen peg broke in August 1971. When President Nixon ended the last link between the dollar and gold, the official $35 price was abandoned. Gold was free to trade on the open market for the first time in almost 4 decades. What followed was the largest bull market in gold's recorded history. From $35 an ounce in 1971, gold reached a peak of roughly $850 in January 1980, 2,300% in less than a decade. The backdrop was stagflation, persistent inflation combined with stagnant growth, a combination policymakers believed was not supposed to be possible under the prevailing economic models. The failure of those models was part of what drove the move. Oil shocks, currency devaluations, war in the Middle East, and a loss of confidence in the ability of central banks to control inflation all compounded. Gold was the receipt the market was writing for that loss of confidence. The peak arrived in January 1980 when Paul Volcker's aggressive interest rate policy finally broke the inflationary backdrop. Gold topped. Within a few years, the price had halved. The aftermath was a 20-year bear market. Gold did not make a new all-time high until 2008, almost 30 years after the 1980 peak. Breakouts, once they end, tend to end for a long time. Chapter 4, 2001. The third breakout began in April 2001, with gold trading around $255 an ounce, essentially where it had been in 1979 before the final surge. 20 years of dead money. From that $255 low, gold rose to a peak of $1,920 in September 2011. Roughly 650%, over 10.5 years. The backdrop was a sequence of currency and banking stresses. the dot-com bust and the Fed's response, historically low interest rates, the Iraq War, the weak dollar decade, and eventually the 2008 financial crisis, which accelerated the move. Central banks, which had been net sellers of gold for 2 decades, became net buyers around 2009. That shift alone was structurally significant. And it continues today. The 2011 peak was followed by a 4-year drawdown to around $1,050 and then a long consolidation. The archive added its third completed chapter. Chapter 5, the fourth breakout. The current breakout, if the archive will ultimately classify it as one, began around 2019 with gold near $1,200 an ounce. By the end of 2024, it had crossed $2,800. The rate of ascent accelerated through 2025. The macro backdrop echoes the others: central bank credibility questions, record government deficits, persistent above-target inflation in major economies, and a new phase of central bank gold buying, this time led by emerging market reserves diversifying away from dollar holdings. Whether the current move will ultimately be classified in the archive as a fourth full breakout, or as something else, is not a question this channel answers. The move is ongoing. The archive categorizes only what has already completed. What we can say, factually, is that the price is at new all-time highs and that the backdrop rhymes with prior breakouts. The rest will be written by time, not by us. Chapter 6. What the 4 breakouts share. Put the 4 episodes side by side. The magnitudes differ wildly: 69% in the first, over 2,000% in the second. The durations differ: overnight decree, a 9-year run, a decade-long ascent, and a multi-year move still in progress. But the setup features rhyme. Each episode arrived during a period of central bank credibility stress, above-trend inflation or currency debasement, and a reassessment by market participants of what the major reserve currencies are actually worth. Gold, in the archive's reading, has never broken out because of a sudden belief in gold. It has broken out because of a gradual loss of trust in the alternative. Chapter 7. The backdrop pattern. 5 features appear in the backdrop of every prior breakout. Taken together, they describe a specific macro moment. Not a price target, not a timing signal, just a description of the weather. Falling or negative real interest rates. A weakening reserve currency. Rising government debt as a share of the economy. Loss of confidence in central bank ability to control inflation, and, in most cases, geopolitical stress. Those features are not predictive on their own. Many periods have shown 1 or 2 of them without a breakout. What the archive catalogues is what happened when they appeared together, and only then. Chapter 8. What this tells us: 3 completed breakouts, 1 in progress, 4 entries in a 100-year archive, which, for an asset class this old, is fewer than most people assume. The chart of gold's last century, seen this way, is not a chart of a volatile commodity. It is a chart of 4 discrete repricings, separated by long stretches of nothing. The long stretches are the majority of the chart. The breakouts are the punctuation. What you do with this archive is, again, your decision, one to discuss with an authorized financial advisor who knows your situation. This channel's job is to hold up the record, not to tell you what to do with it. Next in the archive, the very long economic cycle. 6 repetitions across 500 years of history. Same rules. No predictions, only what the record shows.